Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. International bonds, a smart way to diversify your portfolio. International bonds let you invest beyond your home market, opening doors to global opportunities. These debt securities, issued by foreign governments or corporations, can strengthen your portfolio by spreading risk across different economies. They often provide steady income and act as a buffer when local markets dip. In this video, we'll break down how international bonds work, their benefits, and the risks to watch for. You'll also learn practical ways to add them to your investments. Whether you're new to bonds or looking to expand, understanding international options can help you make smarter choices. Understanding international bonds. International bonds are debt securities issued by foreign governments, corporations, or financial institutions outside of your home market. Unlike domestic bonds, which are issued in your local currency and regulated by national authorities, international bonds cross borders, often in multiple currencies and governed by different rules. They provide exposure to global economic conditions, which can help balance your portfolio when local markets underperform. By diversifying internationally, you reduce reliance on a single economy. Different interest rates, inflation trends, and political climates across regions mean these bonds don't move in lockstep with domestic ones. If inflation spikes at home, bonds from another region with lower inflation might hold steady, smoothing out your returns. Types of international bonds. Eurobonds, foreign bonds, and global bonds are the primary types of international bonds. Each has distinct features. Eurobonds, issued in a currency different from the issuer's home market, e.g., a Japanese company issuing bonds in USD. These bypass domestic regulations and appeal to global investors. Example: Nestlé's dollar-denominated bond in Europe. Foreign bonds, issued by a foreign entity in another country's local currency and regulated by that country's laws. A classic example is Yankee bonds, foreign issuers selling debt in US dollars under SEC oversight. Global bonds, sold simultaneously in multiple markets, often in major currencies like USD or EUR. These cater to institutional investors worldwide. The World Bank frequently issues global bonds to fund development projects. Currency risk is higher with Euro bonds, while foreign bonds can face tighter local regulations. Global bonds offer wider reach but come with complex structuring. How international bonds work. Issuers, governments, or corporations raise capital by selling bonds to investors. The process involves underwriters who price the bonds, negotiate terms, and distribute them globally. Key factors shaping international bonds. Currency considerations. Bonds issued in strong currencies like USD or EUR attract more buyers, but exchange rate shifts can impact returns. If the yen weakens against the dollar, your yen-denominated bond payout buys fewer dollars. Payment structures. Most pay fixed interest, coupons, semi-annually, but some offer floating rates tied to benchmarks like LIBOR. Zero-coupon bonds, common in emerging markets, pay no interest but sell at a deep discount. Interest rates and credit ratings. Higher-rated bonds, AAA to BBB, pay lower yields but default less. Junk bonds from riskier issuers offer juicy returns but come with higher default chances. A country's central bank policies also affect bond prices. Rising rates lower existing bond values. Investors must weigh yield against currency swings and political risks. A stable German bond might yield less than a high-growth Brazilian bond, but it's far safer. So why consider them? Because when one market stumbles, another might thrive, and your portfolio stays steadier for it. Benefits of investing in international bonds. International bonds do more than just expand your investment reach. They add balance, opportunity, and resilience to your portfolio. While local bonds tie you to a single economy, global debt securities let you tap into growth elsewhere. Here's why they're worth considering. Portfolio diversification. Think of diversification like planting crops in different fields. If one field floods, the others still produce. International bonds work the same way by spreading risk across economies that don't always move together. For example, when U.S. bonds dip due to inflation, bonds from countries with stable prices, like Switzerland or Singapore, may hold steady. Political instability in one region, say Argentina, won't sink your entire fixed income portfolio if you also hold German or Canadian bonds. Bonds from developed markets, Germany, Japan, often act as stabilizers, while emerging market debt, India, Mexico, adds growth potential. The mix smooths out returns over time. Higher yield opportunities. Local bonds sometimes offer slim pickings. When U.S. Treasury yields drop below 2%, investors hunt for better returns abroad. Here's where international bonds shine. Emerging markets like Brazil or Indonesia often pay higher interest to attract investors, sometimes 5 to 8% compared to 1 to 3% in developed nations. Corporate bonds from growing industries, Asian tech, Middle Eastern energy, can outpace domestic corporate debt. Samsung's dollar-denominated bonds, for instance, have historically offered stronger yields than similar U.S. tech firms. But higher rewards mean higher risk. Inflation, currency drops, or political shifts can erode those juicy yields. Balancing high-growth bonds with stable ones keeps your portfolio from swinging too wildly. Hedging against currency risks. Currency swings can hurt or help. If your home currency weakens, foreign bond returns gain value when converted back. For example, a European investor holding U.S. bonds profits if the euro falls against the dollar. Even modest bond gains amplify when exchanged back to euros. Diversifying currencies, holding bonds in USD, JPY, and GBP protects against one currency's sudden crash. Of course, the reverse is also true. A strong home currency can dilute foreign bond earnings. Mixing bonds in different currencies acts like a financial shock absorber. The bottom line: international bonds aren't just for the wealthy or institutional investors. With the right mix, they can fortify your portfolio against local downturns and unlock growth you'd miss at home. Risks associated with international bonds. International bonds can strengthen your portfolio, but they come with unique risks. Currency swings, political shifts, and credit downgrades can eat into returns or even put your principal at risk. Understanding these challenges helps you navigate global bond markets with confidence. That's it for part 1. We've covered the basics of international bonds. Stay tuned for part 2, where we'll dive into how to choose the right ones for your portfolio. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.